Hello everyone and welcome back. In my last video, I outlined my plan to borrow $65,000, invest it in several stocks, and use the dividends to pay back the loan. I also went over my experience with investing and gave some background on myself. Make sure to go back and watch it if you missed it. And please give a thumbs up if you enjoyed it. That will really help others find these videos. In this video, I want to go over which stocks I'll be purchasing. But before we get to that, let's go over my criteria. I'm looking for stocks that have these 4 requirements. First, they need to have a high yield, around 5% or higher. Second, have a long track record of paying dividends. Third, have a long track record of increasing those dividends. And fourth, companies that don't have a history of cutting their dividends. It's understandable that during a recession, companies may reduce the amount of money they pay to their shareholders. But I don't want companies that cut their dividends because of poor financial or business management. So with those 4 requirements in mind, let's get into it. The first stock I want to purchase is Enbridge. Enbridge is an energy company that focuses on the distribution and generation of energy in North America. It's part of the oil and gas pipeline industry with a market cap of $84 billion. I picked this stock for 3 reasons. 1, they have a monopoly. Everyone that lives in my area uses Enbridge. Where I live, you don't choose your gas company. You buy a house, and Enbridge just sends you the bill and you pay for it. So if anyone living around me wants to heat their house, they're going with Enbridge. Second, it's recession proof. In a recession like the one we're currently in, heating your house is going to be one of the last things you cut. If people lose their jobs or see a loss of income, they're going to cancel cable, Netflix, they're going to stop eating at restaurants. I don't think anyone's going to say, you know, I've got this blanket, some sweaters, a toque. I'd rather watch Love Island than heat my house. And third, the yield. Enbridge sits at an amazing 7.53%, a perfect fit to help repay this loan. They've been paying a dividend for the past 28 years and has consistently gone up year after year. Stock number 1, check. The second stock I chose is Bank of Nova Scotia. It's a Canadian multinational bank and financial service company, and the 3rd largest Canadian bank by deposits and market capitalization. Canadian banks are among the safest in the world because they're considered less volatile than other sectors and have a good history of paying their dividends. Likewise with Enbridge, banks are relatively recession-proof. If people lose their jobs, they unfortunately can't pay their mortgage. This can happen, but more often than not, people are going to do whatever they can to pay their mortgage and the banks. Now, you can't really go wrong with any of the top 5 banks. Royal Bank, TD, Bank of Nova Scotia, Bank of Montreal, or CIBC. I chose the Bank of Nova Scotia for this portfolio because it provides the highest yield at 6.24%, and it's been paying its dividend for the past 18 years. They are also a dividend aristocrat, which means a company that not only consistently pays a dividend to its shareholders, but annually increases the size of its payout. Stock number 2, check. For my third stock, I went with Bell, a telecommunications company with a market cap of $52 billion. They provide phone and internet service to Canadians, as well as own many other subsidiary companies, such as Bell Media, who owns Crave, a popular streaming service, and Virgin Mobile, to name a few. They also own 18% of the Montreal Canadiens hockey team. Out of all the Canadian telecommunication companies, Bell pays the highest yield at 5.77% and has been paying its dividend for the past 31 years. Making them another dividend aristocrat company. Stock number 3, check. So those are my 3 stocks: Enbridge, Bank of Nova Scotia, and Bell. My plan is to put $20,000 in each, but that will leave me with an extra $5,000. With that money, I think I'm going to go with a more risky, yet still established company with a very high yield. I already own this company and other accounts I have, and I've been very happy with it. I'm talking about RioCan, the 2nd largest real estate investment trust in Canada. It has a huge 9.3 yield, which means even if they do cut their dividends, like H&R REIT has recently done, it'll still be making around 5% yield. So let's add RioCan to the list. So here are my 4 stocks. I'm pretty happy with them, but in discussion with my friends, they were saying that putting all my money in just 4 stocks is very risky. And they're not wrong. Even though I'm confident that these 4 stocks are great, solid companies, I would feel terrible if something does happen to one of these companies. I feel like borrowing money to invest is already risky, so I'm going to side with being more cautious. First, let's pick another bank. Since choosing any of the top 5 banks would be a good pick, let's go with the bank with the second highest yield. Coming in at 5.22% is Bank of Montreal. Let's do our due diligence and check if the dividend payout looks promising. Yep, that's an upward trend, exactly what I like to see. Let's double check if they're a dividend aristocrat. And yes, they're on the list. Let's add them. Now let's pick the second highest telecommunications company. While the yield is not impressive, it's also not bad. I mean, Apple pays 0.33 yield, Amazon pays 0%. So while TELUS's 4.76% isn't close to my 6% requirement, I will side on being safer. A positive about TELUS is that it is a solid company that will continue to grow. For the past 17 years, TELUS has been increasing their dividends, and I'm confident that trend will continue into the future. Sure, in the 2008 recession, we saw a dividend cut, but you'll notice that after a few months, it not only goes back to what it was, but it surpasses it. So yes, it's a lower dividend, but that will go up as time goes on. Okay, so let's review. We have Enbridge, Bank of Nova Scotia, Bell, RioCan, Bank of Montreal, and now TELUS. Since I do like my original 3 stocks, I want to give them a higher weight than the other lower yielding stocks. So let's break it up like this. Enbridge is going to get a full 20K. My 2 banks have similar yields, so Bank of Nova Scotia will get 13K, while the Bank of Montreal will get 7K. Then Bell will get 15K. TELUS only gets 5K because of its low yield. And that leaves RioCan with the remaining 5K. And there you have it. That's my all-star team. Let's go and invest. Hello again. A few days have passed and I've done all the investing. The first thing you'll notice is all this red. Yes, the stocks have fallen in value, but that doesn't bother me. Stocks go up and down all the time, but the loss is only realized if you sell. This is going to be a 10+ year journey. The short-term price is irrelevant to me. The important thing is that by the time this loan is paid off in 10+ years, these stocks are going to be in the green. And more important, the stock price doesn't have any relevance to the dividend payout. So whether the stock price rises $100 or falls $100, the dividend will be the same. You could check back in 1 week, these might all be green, then the next, and a few might be in red. That's fine, that's normal. The important thing is that these are all solid companies and I'm excited for the future. Well, I'm going to end it there. Thank you everyone that's made it this far into the video. Remember to hit that like button. I really appreciate it and it'll help others find this video. And if you'd like to see more videos updating everyone on the progress of this investment, please hit that subscribe button so you'll get notified. Thank you all for watching and take care.